$71 billion. That's the number DeepSeek is reportedly raising at right before an IPO, using a fraction of the compute everyone assumed you needed to build a frontier AI model. And that number has one investor asking an uncomfortable question about a company most of us can't even buy stock in. Anthropic is one of the most valuable private companies on the planet, sitting on a moat that doesn't actually exist. Stick with me, because the answer matters a lot more than just one company's stock price. Hey Profiteer, Eric here. Welcome back to Real Money Stories. Today we're digging into a post from the investing subreddit asking whether Anthropic's valuation is headed for a hard landing. This isn't a story about a paycheck or a stack of credit card bills. It's a $200 billion question mark from someone who's pretty sure they're seeing something the market is missing. Let me read it to you in their own words. I know this is probably an unpopular take, but I think the market is massively overestimating Anthropic's moat. Bloomberg is reporting that DeepSeek is already preparing for an IPO after reportedly raising at around a 71B valuation, and they got there by showing you don't necessarily need insane compute budgets to build frontier models. Meanwhile, models are becoming more interchangeable. OpenAI, Google, DeepSeek, Meta XAI. Every few months, someone catches up. So what exactly is Anthropic's moat? They don't own consumer distribution like OpenAI, Microsoft. They don't own search or Android like Google. They don't own the hardware like Nvidia. They don't have Meta's user base. If AI models keep becoming commodities, I don't see how Anthropic justifies one of the highest private valuations in the world. Honestly, I wouldn't be surprised if the secondary market keeps repricing it lower. Am I missing something, or is this one of the most obvious overvalued AI companies right now? Okay, honestly, my first reaction is that this is a genuinely sharp question. It can feel like you're an outsider posting a contrarian take, with 300 people ready to argue back. I want to say up front that this person did the homework. They named the actual competitors. They named the actual advantages those competitors hold. That's not a hot take, that's an analysis. I've been writing about money for over a decade now, and the pattern I keep seeing with hyped private companies is this. The story gets simpler as the valuation gets bigger, and the moat question is usually the first thing that gets skipped. So let's slow down and actually walk through the reasoning. First framework, it's called the economic moat, and it comes from Warren Buffett. A moat is whatever keeps competitors from eating a company's profits, things like network effects, switching costs, patents, or owning a piece of infrastructure nobody else can replicate. And here's why it matters for exactly this question. The original poster is right that Anthropic doesn't have a moat in the classic sense. It doesn't own distribution the way Microsoft bundles OpenAI into every Office license. It doesn't own a search engine funneling billions of users, unlike Google. What Anthropic is betting on instead is being the best at the underlying model itself, which is a much thinner moat than owning the pipes people use to reach that model. Second framework, and this is really the heart of the Reddit post. It's what some people call the commoditization risk, or the Red Queen effect, named after the character in Alice in Wonderland who keeps running just to stay in place. And here's the mechanism. When every major lab, OpenAI, Google, Meta XAI, DeepSeek, can close a capability gap in a matter of months, no single lab gets to keep a durable lead. DeepSeek proving you can get near frontier results without a 9-figure compute budget is exactly the kind of evidence that supports the original poster's worry. If the expensive part of the business becomes cheap, the thing you were charging a premium for stops being scarce. Now, here's where it gets complicated, because the obvious next conclusion that cheaper compute automatically hurts Anthropic isn't actually settled. Cheaper compute cuts both ways. It lowers the barrier for new entrants, sure, which is bad for Anthropic's pricing power. But it also lowers Anthropic's own costs, and it means the companies with the deepest pockets, the ones who can also buy distribution, enterprise contracts, and safety credibility, might actually be the ones who consolidate the market once the cheap model gold rush shakes out the smaller players. A commodity market doesn't always mean everyone loses. Sometimes it means only the players with capital and trust survive, and Anthropic has spent years building trust with enterprise customers who care a lot about safety and reliability. That's a real, if unglamorous, form of moat. It's just not the kind that shows up in a bullet list of who owns what hardware. Third framework, and this one is honestly more important for how any of us think about this than the Anthropic question itself. It's called mark-to-model pricing, and it's why private valuations behave so differently from public stock prices. And here's why. A public stock reprices every second based on what someone is actually willing to pay for it right now. A private company like Anthropic gets a valuation set at each funding round based on what a small number of investors agree to pay, and that number can sit there unchanged for a year or more, even while the underlying business story shifts underneath the surface. So when the original poster says the secondary market keeps repricing it lower, that's the real signal to watch. Secondary market trades, private shares changing hands between existing investors, are the closest thing a company like Anthropic has to a live price check. If those trades are happening at a discount to the last official round, that is meaningful information well before the next headline valuation gets announced. Fourth framework, and this is the one I'd actually want the original poster to absorb. It's called concentration risk, the idea that putting a large chunk of your money behind one company's fate, no matter how convinced you are of the thesis, exposes you to swings a diversified portfolio simply doesn't carry. And here's the useful irony in this particular case. Most of us can't directly buy Anthropic stock anyway, it isn't public. Which means the real lesson isn't, should I bet against Anthropic? It's, am I comfortable with how much of my portfolio rides on the fortunes of a handful of AI companies? Whether that's through a fund with heavy tech weighting or individual holdings. For most people, broad, diversified index exposure across the sectors benefiting from AI, rather than a bet on which single lab wins, is the more resilient way to participate. I'd suggest anyone turning this Reddit thread into an actual investing decision talk it through with a qualified financial advisor about their specific situation and risk tolerance before making any moves. So if this is a question you're actually wrestling with, here's the next step. Don't try to answer, will Anthropic's valuation hold? Answer the smaller, more useful question first, which is how much of your own portfolio's outcome depends on any single private company or trend, and whether that number makes you comfortable. Just a friendly reminder that this episode is intended for entertainment and education purposes only and should not be considered financial or legal advice. Here's the so what. The specific question in that post was about a $71 billion IPO and one AI lab staying power, but the principle underneath it, that a thin moat plus a concentrated bet equals real risk, applies whether you're weighing $100 or $100,000. Hype doesn't build a moat. Distribution, switching costs, and trust do, and the smartest move is usually just asking the boring question nobody wants to ask out loud. If you found this helpful, share it with someone dealing with the same thing. Until next time, stay profitable.